Well, cash is what tells you that the business is actually healthy. So the fact that operationally speaking, even including the stock-based compensation, basically the business of Palantir is able to sustain its business without the need of rising capital. It means that the unit economics of the business actually work well. Now, I think we need to think a little bit in terms of game theory. What if you were Carp? How would you manage the company right now? Because one thing that I keep asking myself is, let's say Palantir is able to squeeze more revenue from the customers right now. You have more free cash flow. Okay, fine. What do you actually do with that free cash flow? Giving it to shareholders doesn't make no sense now. You keep piling up the cash. That is great. Helps your business risk free. So, but at the end of the day, that would not really change the core question of the company. Let's say if you squeeze 10% more from your existing customers, meaning that you have 10% more just for the price increase in terms of revenues. So you have organic growth plus the price increase. Let's say you reach 20%. Does that change to you very much? Okay, you have more free cash flow. But again, what do you do with that free cash flow? I think given the setting, if I were Carp, and I think of the most important thing is not to show growth now, but to be sure that in 10 years from now, I solve the monopoly question. And in order to be sure that I solve that monopoly question, I would not give an F to the current revenue growth. I would only focus on we need to unlock the value of our customers. So our customers need to, in 10 years from now, they need to have not 50 million on average. They need to have 200 million per customers, because these existing customers need to have a foundry even when the employee go to the bathroom. If that happens, you don't really care of the current revenue growth in 1 year, 2 year. You only care in 10 years, the existing customers have a foundry full stack in whatever thing they do. Because if that happens, then you have the monopoly unlocked, which gives you the pricing power to basically raise prices 10% every year, and the customer will just say, okay, I have no choice.
And the street will sell it off, which will be the greatest dip for us.
Oh, yeah.
Right? Because if the revenue is not good, as you're saying, if Carp's intention is to not make revenue growth good, the street's going to be like, all right, screw you guys.
So that's exactly the setting with which I'm trying to look at it. If things go in the normal direction, okay, fine. But there could be a huge opportunity, in my opinion, if we would see the company just growing little in terms of revenues, because we don't know. Like that's the interesting and also the challenging thing, that maybe a 13% growth, 15% growth is actually extremely good, because what Carp is doing is, well, rather than selling you one product for 100, I'll give you 5 products for 150. In terms of growth, that's very little. But if you have that 5 products, that actually help the company grow even faster with its use of Foundry, which means that in 5 years from now, 10 years from now, when basically you are completely reliant on that, then the customer can't move and you can charge him whatever you want. So that could be the case, like as I made last year, where I said that could be the case where the customer count increases and the cost go up, killing the profitability. That would be an opportunity for investors. I see a similar setting, but now with not on the cost as it was last year, because we were starting from 30% growth free cash flow margin that went to 20%. My ideal case right now, that the gap profitability question has been solved, is seeing the revenues growing very little, but the number of customers exploding, having some hints, like with the press releases that we keep having, like West Truck last day, after 2 years, a further expansion, if we have the hint that the revenues grow very little, the market hates it, but we have the customer count exploding, basically confirming that the company is de facto dumping the product. They can't give it for free completely because that's illegal, but you can make a good deal for the customer. That to me would be the biggest opportunity, because that would kill the price, but intrinsically we would know that that is the perception that is wrong. It is not the reality. It's not similar, not different from what we saw with Wood. The market focused on one metric that is very important, like the monthly active users. But if you focus on that and you don't grasp the full picture, you would think, okay, Robinhood sucks. But the reality is the company has been doing the right thing. The company has become GAAP profitable, even in a very adverse situation like Palantir, which means that when the conditions finally aligned, if you already got profitable in the worst condition, at the good conditions, you start printing money hard. So that's the setting I'm seeing.
Yeah, I hope everyone heard what you just said correctly, because I've been thinking about that for a while. If customer count explodes and revenue declines and the street sells it off, that is when you buy the fucking dip. Because we could have a dip where you're not supposed to buy it because it's not justified to buy it because all the metrics are off and the street actually tanks them for a good reason. Those high frequency trading algorithms care about a couple of metrics. If those tank, you sell it off. But if you're a real investor in Palantir and you know what they're trying to do, you know they're solving problems for industries, they're, you know, taking their R&D from one industry to another and then scaling from there, then that scenario Arnie describes of customer count goes up, revenue declines is, I think, a dream scenario for an actual dip that we want to get.